It's my honor to welcome legendary hedge fund manager, Mr. Mohnish Pabrai, on the show. Mr. Pabrai is the managing partner of Pabrai Investment Funds, a global value fund with a AUM of more than $700 million. The fund has handily beaten the market since its inception in 2000. In 2008, Mr. Pabrai made news by bidding $650,000 with his friend, Mr. Grice for a charity lunch with Mr. Warren Buffett. His book, The Dhando Investor, is a must-read for investors and non-investors alike. The link for the book will be beneath the video for those who are interested. And, thank you for joining us today. And I would like to welcome you to the show.
Thank you, Siddharth. Pleasure to be here.
I would like to begin with some of the esoteric concepts that investors have a tough time wrapping their heads around. And one of them is intrinsic value. Investors run into a lot of trouble when they're trying to project out cash flows. These are typically 10-year projections, maybe more sometimes. And then they have to base the intrinsic value of that projection. So how do you, as an investor, reconcile the uncertainty of the projections with the need to perform these projections? And how do you approach the subject of intrinsic value, Jim?
Yeah, Siddharth, I think that's a great question. So intrinsic value, the definition of intrinsic value is relatively simple. Calculating it in most cases is far from elementary. So actually it was John Burr Williams who came up with the concept of intrinsic value and defined it several decades ago, and maybe about 100 years ago. And he said that it was the sum of all the cash you could pull out of an enterprise between now and Judgment Day. And then you would discount it back to present value by some reasonable interest rate. That would be intrinsic value of the enterprise or a real estate or anything else you're looking at. And of course, when we apply that to businesses and stock market equities and so on, it is a far from elementary exercise, because projecting cash flows for a business several years out, even the insiders in the business who maybe have even been running it for 10, 20, 30 years may have difficulty with that exercise. Outside investors who don't have the same level of, expertise or granularity about the business would be even more handicapped doing that. At the same time, making investments without having a good sense of intrinsic value is a fool's errand. There are hacks, and we can use hacks to get to the promised land. The first hack is that we don't need to know the intrinsic value of everything, and we should not even aspire to that. Most stocks would fall outside the circle of competence of a given individual investor or an institution. So if something is not within circle of competence, there's no need to try to figure out what it's worth, because we're not going there. So that becomes one, and large swaths of equities would be outside my circle of competence. So for example, if I look at anything in biotech, I have no edge or anything I can bring to that party. If I'm looking at industries or businesses with a lot of technology that I don't understand, again, it's the same thing. So, or if it's an industry which I just don't understand what are the main factors that drive it, lots of businesses go by the wayside because they fall outside of circle of competence. Other thing that we can do to put the odds in our favor is we don't necessarily need to figure out intrinsic value. What we need to figure out is it's above X, where X would give us acceptable return. So we may not be able to come up with a precise number, but we may be able to come up with a number that, a stock is trading at 50, the intrinsic value is over 80, for example. So that would give us, some basis to proceed. We can also get to the liquidation value of a business in most cases relatively easy. Sometimes liquidation value exceeds the stock price. So then again, it becomes a hack where you could say, well, I know liquidation value is more than 2 or 3 times the stock price. And I know that liquidation value is not going through degradation or is unlikely to go down. So we can do that as well. There are a number of different ways that can be approached. I remember, I think it was 2005 or so, There was a steel company. It was headquartered in the US, but most of their plants in Canada. Company called IPSCO. IPSCO made tubular steel, basically steel that was used in pipelines. And they used to have these multi-year contracts because people are building out these long pipelines that they would place orders with IPSCO, which were firm orders because they wanted to make sure they were getting the pipe they needed. So IPSCO many times had visibility, multi-year visibility into their earnings. They had announced in 2004 that for the next 2 years, they would make $15 a share in net income after tax. The stock was trading at about 45 per share. There was about $15 a share of cash on the balance sheet. There was no debt. And we had this, next 2 years of $15 coming in. And they had a lot of other assets, plant, equipment, inventory, etc. So if you excluded everything else and you just held the stock for 2 years, the cash on the balance sheet would equal to the current stock price. So IPSCO was a very cyclical business. Even the insiders probably couldn't tell you what the intrinsic value was. But I didn't really care. My take was okay, let's buy the stock, let's hold it for 2 years, and let's see what the market decides the company should be valued at that point. I couldn't believe that a business with $45 of cash on the balance sheet would still change hands at $45 when they had all these other assets. Their earnings could well have gone to zero in year three, or they would have fallen off 70%, or they could have stayed flat or gone up. There was a very wide range of outcomes. Probabilistically, it was a good bet. And so a year later, IPSCO announced that they had one more year of earnings visibility and they were going to make another $15 share. So now, I mean, shortly after I bought, the stock had gradually drifted up to 60. And then when they announced this one more year of visibility, etc., it continued to move higher and it was trading at about $90 a share. And I had held the shares for about a year and a half. I was saying, well done, Monish. It worked. But since we have no further visibility and we know this is a cyclical business, maybe it's time to get off the bus. And as I was running through that thought in my head and thinking about, it might be time to, we can double in less than 18 months or so. There was an announcement that came out that a Swedish company had made a offer to buy IPSCO at $160 a share. And when I woke up that morning, I think the stock was trading at 150 or 152 or something. One femtosecond after that, I sold all the shares. And that deal actually closed and IPSCO became a private company, part of the Swedish group and so on. But, that's an example of where there was more value there than what the market was ascribing. Sometimes the market gets confused with risk and uncertainty. There's a business I invested in 2019 in Turkey, which is the largest warehouse operator in Turkey, Resas. And their liquidation value, which was relatively easy to get to because they had 12 million square feet of Class A prime warehouses, 20% were refrigerated, 99% leased, 10-year inflation indexed leases. The market cap was 20 million. The liquidation value was over $1 billion. And there was about 200 million of debt. So if you took out the debt, you were buying something for 3 cents on the dollar or something, 2.5, 3 cents on the dollar. Again, in that case, there were cash flows and other things going on. Intrinsic value was probably over 800 million, but they were very good capital allocators. My estimate by the intrinsic value might be 50% for liquidation. But I didn't need to figure it out. We were buying at 20 million and liquidation value was 800 million. Good things were likely to happen to us. So there's another company, I think in 2015, Rain Industries, we still own it. This is a very cyclical business with some significant volatility in earnings, but they're also low cost producers. So they don't really lose money even at the down cycle. Rain Industries had a market cap under 200 million, 2 billion. There was a very high probability I felt that in the next 4 or 5 years, earnings in a single year would exceed 200 million. And again, I just wanted to hold the stock to see what happened when that single year earnings went to that number. And I thought that was, odds were high, it would happen within 5 years. So my take was, okay, we don't have a downside. We have an unknown upside and can go in. We don't know what intrinsic value is, but that's okay. Within 3 years, their earnings hit the 200 million and the market cap got close to 2 billion. And in my infinite wisdom, I did not sell because by then I was in love with the business. And then it went down. And now I think it's about 700-800 million or so in market value. So we have a gain, but and I think we will get past the old 200 billion by in the fullness of time. But that was another example where you couldn't lose money. You didn't have to figure out intrinsic value. So on. So I think the hacks are important because many times a straight DCF. So one of the rules I use is that if you need Excel to figure out what the intrinsic value is, there is a problem. If you cannot do it in your head, there's a problem. If you look at a business like Starbucks or McDonald's, for example, I think the odds are very low that these businesses have lower earnings 5 or 10 years from now. Those are pretty low odds. The place with the area which gets complicated is how much higher would, right? And so you can always take a conservative view on these businesses and say, okay, well, I've got a long history with these businesses. I can look at the history. I can look at it. China's got 5,000 stores and maybe it could be 10,000 in 5 years or something. Those sorts of things. And you could make some extrapolations. Those types of bets can pay off extremely well. The math is a little bit more. It requires you to make more assumptions than I need to make with RESAS or RAIN or IFSCO and so on. But that can work as well. But the important thing I think is that because we live in a world with 50,000 listed companies, there are always businesses and regions and industries that are going through some kind of overhang, which is making it easier to get to at least floor intrinsic value. And so focusing on those is a good way to go. Like I think Buffett has a quote. He says, we like to buy great businesses when they are on the operating table. And so I think a lot of great businesses go through temporary hiccups. And the temporary hiccups can help us make it easier to figure out intrinsic value and get in at a price below a conservative assessment.
I think the investment process is made even more difficult by, especially in the US, just the sheer number of eyes looking at securities. You have more hedge fund and mutual funds now than you have at least public listed stocks in the US. And so how do you screen for ideas? And I mean, you mentioned cloning as one of the ways, 13 apps. You look at other resources and what have you found to be the most effective way to do so?
Well, we wait for something to hit me like a 2x4 on my head. And when something hits me like a 2x4 on my head and jolts me, then that usually means I should dig further, etc. So if I can find 2 investments in a year that we can make, I think we're doing well. I think through the first 8 months of 2022, I found 1 investment. And just recently, a second one popped on the radar. And I think this one will work. And so it's a good year. It's a wonderful year. And who knows what 2023 brings or what 2024 brings. It could be 0 or it could be 4. We don't know. So on the one hand, you have the 50,000 stocks. On the other hand, we only need a couple of ideas a year, maybe less. And so with that large a universe sifting through things and being, just asking basic questions like, is this within circle of competence? What is this worth? And that sort of thing. It will get rid of a lot of companies. And we can use hacks to reduce the data set. One hack you could use is, for example, if you limit yourself to only buying businesses that have a write up on Value Investors Club, for example, because that's a very well curated site. It's difficult to become a member. You have to keep submitting a couple of ideas a year that are decent to keep your membership, etc. So the average idea on Value Investors Club is better than throwing darts at a board and picking an average stock to research. So if you use the Value Investors Club as a starting point to doing research, it trims down the data set quite a bit. And the write ups are pretty good. So if you just went through and just read the write ups and then just left with the ones that you think are businesses you understand or thesis that you agree with, then that becomes a basis to do more work and see if any of those can jive with you. So that can be a good source. Data Roma, which gives the 13F filings or a bunch of great registers, that can be another great source. Barron's could be a source. There's a number of sources you could use. Through that mix of things, trim them down. I made my first trip to Turkey in 2018 because the currency was very unstable. Everyone and their brother was leaving the country en masse, and the markets optically looked really cheap. So I had a good friend in Turkey, and I just said, "Listen, can we just go and visit every business in your portfolio?" I didn't want to visit every listed company in Turkey. I wanted to visit the ones that had already gone through his filter. He had actually put money into it and so on. And that was a great trip. Found a few things that look interesting. And then the following year, I made another visit in 2019. That's when we visited Resas, 3% liquidation value and so on. So I think that there can be a number of different ways in which you can create the the research list, if you will. Could be Value Investors Club, other publications and other barons, Roma, or might say, okay, particular geography might hold some promise and let me dig further and so on. So there can be a number of different ways in which things can enter the funnel. Since the output from the funnel should ideally be pretty small, because I think most of us probably cannot find more than two, three, four things that make sense. And that's a good way to go.
Sure. And when you look at your investment process, are you working at multiple ideas at once? Are you just working on one investment at a time? And do you read industry journals, transcripts, annual reports, all of those? How do you go about aggregating data, I guess, and then attacking these investments? Is it one at a time or simultaneously?
Well, like for example, this is a good time right now because a lot of my energy is focused on one particular company, right? That I'm drilling down on. At the same time, I'm reading several newspapers every day. Value Line shows up once a week, and my assistant gives me a PDF of, like, for example, all the ideas posted Value Investors Club in the last month or something, and so it's a mix. I would say that at this point, probably 80-90% of available horsepower is being directed to one business. And I'm still looking at a bunch of other things. Most of those get discarded pretty quickly. If something shows up on the radar that looks interesting, then I will relatively quickly try to figure out which of the two businesses I now have are the ones, which of the two should be given more priority. And then we take it from there. Basically, to try to do a comparison, try to see which one risk adjusted is a better bet and so on.
Do you believe in having some other intelligent investor as your partner, similar to Mr. Buffett and Mr. Munger? And if so, how do you avoid maybe confirmation bias or groupthink in that case?
Yeah, Charlie had told me a long time ago, almost like within the first or second meeting I had with him in 2009. He told me, Monish, it's really important to have someone to talk to about your investments. So I told him, oh, you mean like Warren Buffett? So he said, well, it wasn't always Warren, but I've always had someone to talk to. I actually incorporated that. I hadn't thought about it that way till then. And I made a deliberate attempt after that to seek out other opinions. Sometimes people, the company, sometimes people differing opinion on the company. and such. Yeah, I mean, John Templeton says that the best of us will be wrong 1 or 3 times. So if I make 6 bets in 3 years, even though I'm making 2 bets a year, according to John, 2 out of those 6 bets at least might be, that's a minimum. It would be actually 3 out of the 6 bets don't do what you expect them to do. They do far worse than what you expect them to do. Now, my hope is you don't have permanent loss of capital, that if it doesn't work, you get your money back or something. But many times you're not that lucky, so you may suffer some loss of capital as well. And so that's just par for the course. Even when I look at Warren Buffett's investments, and if you were to look at like his, let's say, 70 or 80 acquisitions that he's did at Berkshire, easily more than a third of those have not worked. So, and this is Warren Buffett with Charlie Munger, with a lot of, the best of the best. And the good news at Warren has been that the larger ones in general have worked. And so if you dollar weight it, he's had a very high success rate. But if you equal weight every one of those 70 bets, it would be a terrible record relative to what we've seen with Berkshire Hathaway. Like they made a large number of investment in furniture retailers. I think every single one of them except Nebraska Furniture Mart never worked. Lots of investments in jewelry retailers. And every single one except Borsheim's did not work. In fact, most of those businesses during the financial crisis would have just gone under. I think they only stayed alive because they had the support of the parent. So they would have basically been zero in a number of cases. I think that, yeah, it's important. Anything that you can do to bring the error rate down. So talking to other people who don't have any biases or, a reason to agree with you and such, and are more objective, and that can be a great asset.
Mr. Buffett describes a great business as one which has a wide moat around it. And I think what I believe he's always been focused on is identifying moats in a big addressable market. How do you personally approach a business which you believe has a moat? Do you, is it something that comes to you naturally over a period of time through collection of a bunch of insights, or do you actually go about it in a more intentional manner? And you really try and identify what is the moat of this particular business, even when it's not obvious.
A business that is within your circle of competence, the moat will be very apparent to you when you just think about the business. And then it would get ratified when you look at the numbers. So, generally speaking, a great business is going to be generating high returns on equity without much use of leverage over a long period of time. So that's going to give you the proof of the pudding, if you will. But I think before that, so for example, even before I look at the numbers for Starbucks, I know it's a great business. I mean, I know for a fact that when they open a store in the US, they get all their money back in 2 years. So Starbucks doesn't franchise at all. It's all company owned stores, except the ones at the airport. So they don't have a choice. When they open stores overseas, like in China, etc., they get their money back much faster, like 15 to 18 months. So the payback is even faster. I mean, that is a business that is generating something like 36% unlevered return on equity with a massive run ahead. If you just think about the number of Starbucks stores that might exist in the world eventually, and at which point they kind of stop growing or grow very little, that day could be pretty far away. They have a huge runway. They've already done so much for so many decades, still keep ranking. When you look at a business like that, and, we encounter Starbucks because we customers, and a lot of moats should be apparent to you. So first of all, if you just looked at all the products and services that you as an individual consume, you would be surprised how many of them have deep moats. Because in general, for a random business to convince you that they deserve a share of your wallet is a pretty high bar. We all tend to want to get good value and, you know, products or services that enhance our lives. And especially if we have deep loyalty towards those brands and such. So, the brand of razor you use, the brand of shaving cream you use, the brand of toothpaste you use the time you wake up, your soap, your shampoo, your breakfast brands, and the clothes you're buying, and the cars you buy. It just goes on and on. We encounter a lot of brands, and we are using a lot of brands and a lot of products and services. And when I bought my home, the insurance company required me to have kind of a alarm service like ADT before they would write the policy. And ADT has a moat. Other companies are requesting me to get their service. If you are a corporation issuing a bond, you can't get it out unless you're rated by Moody's and S&P. And Moody's and S&P have a moat because it's written into the covenants and such, and so on. So I think that knowing what is a great business is not a difficult exercise. Then the next piece, which is it a great investment? That's a much more difficult question.
So Mr. Buffett used to do scuttlebutt for speaking to suppliers, competitors, and ex-employees and uh, people who were from that industry. So a particular industry. How much do you believe in scuttlebutt now, since we have so much public information on all these companies available? And do you personally find it useful, and do you use it on a recurring basis, or is it just something maybe you do once in a while?
Phil Fisher was the big advocate of scuttlebutt and originally wrote about it. I think it's a really good thing to do. I should do more than I do on scuttlebutt. I do try to think about who I can call, who I can talk to, who might be either user of the product or service, and or myself be a user of the product or service, and that sort of thing, or might have insights as a competitor, customer, supplier, and so on. I do try to think through those. I think I could do a better job than I've done in the past, but it's a wonderful add-on to the research. Absolutely.
An extension to that question would be, do you believe in meeting the management team? Because we've spoken to a number of management teams, and they're very different. Sometimes you get some strategic views from the management team that may not be obvious from the financials. Sometimes you just get the transcripts pretty much read out to you almost. So when all the information is public, do you find it useful still to speak to management teams? And if so, then what are the few things you're looking for?
Yeah, I used to almost never meet or interact with management. Of course, when I first started, the capital base was so small that no one would be interested in meeting me anyway. So that was, not even a choice. I think Ben Graham was always kind of opposed to the idea of meeting management teams. He wanted methods that could be used by retail investors that were replicable, so on. In general, one of the dangers of meeting management teams is that the guy at the top typically has great sales and got the job because of his sales skills. And you'll be talking to a salesman about business that he understands a lot better than you ever will. And so his ability to sway you, distort reality is pretty strong. A better approach to counter some of that is to look at the track record. So I think it's more important to look at the track record of what a management team has done, which we can tangibly look at, rather than rely on forecasts that they're making. So it's not that they're deceitful. The other trait that a lot of management teams share, CEOs share, is they're optimists. And they could not lead if they were not optimists. And so if you are in the presence of an optimist who's a great salesperson who knows subject code, loves his business and so on, you may get a distortion that is not going to be positive for your long-term returns. On the other hand, if you've got most of your data from the historic record and extrapolating conservatively based on that record, that's a better basis. Sometimes just meeting the management teams can help you. You might see some issue which is bothering you and that may not have been visible if you didn't meet them. So that can be helpful. They can also actually be pretty helpful in helping you see if you've gotten the right models. Most businesses are run by leaders who know that two or three variables will drive 80% of the outcome. As investors, it's very important for us to be honed in on the same variable. And it may not be we may not always get to the same variables. Sometimes meeting the management teams and understanding how they look at the business and how they run the business and what are the metrics they care about. And then if you just make sure that you have gotten to the right three, four variables that will drive most of the outcome and you are able to handicap those variables, then you get a basis. So I think that's the other piece that could be helpful in meeting them.
Wonderful. And to segue, we had Mr. Gaspier on the show a couple of weeks ago, and this is a question I asked him, and he accompanied you to the lunch with Mr. Buffett. I think it was in New York. And, I asked what his takeaways were and how his relationship has evolved over the years with Mr. Buffett. And you've also developed a friendship with Mr. Munger through the lunch. So could you maybe speak about that a little bit?
Well, I mean, I think the lunch with Warren blew away both of our expectations by quite a mile more. I had very low expectations going into the lunch. The driver to bid for the lunch and pay the amount we did, I just wanted to thank Mr. Buffett in person. I felt like I had used his intellectual property or everything I'd pretty much make my livelihood on is based on his IP that he's made public domain. And I just wanted to look him in the eye and just say thank you. I didn't really have any expectation beyond that. What was really surprising to me is that when Buffett comes to these lunches, he has a different mindset. His mindset is he wants to make sure that the person who won the lunch, whatever amount they paid, at the end of the lunch, they feel they got a big bargain. So his focus is to make sure that people think they got their money's worth. My focus was just, I wasn't looking to get my money's worth. I just wanted to thank him. And so the thing is that the lunch went on for almost 3 hours. It could have gone longer. He had pretty much told us he's got the whole day free. He was with us for as long as we wanted to have him. I think later when I made a list of questions I could remember different people asked, there were like 54 different questions and such that I was able to remember. Yeah, I mean, I think the lunch had a number of, well, I mean, I think in hindsight, he delivered, unbelievable amounts of value to us. Basically, every question he would answer it in a manner that tried to add value to us. Like I asked him an innocent question about, hey, you and Charlie had a third partner, Rick Guren. We haven't heard from Rick Guren in several decades. And are you in touch with him? How's he doing? And Warren said, yeah, I'm very much in touch with Rick. And in fact, I get a card from him, play bridge with him periodically and so on. He said, Rick is doing great. And then, he proceeded to highlight how Rick got margin calls in the 73, 74 collapse and how Warren bought his Berkshire shares at like $40 a share, 10,000 times or more amount today. He said, look, if you're even a slightly above average investor, you spend less than you earn and you don't use leverage. You cannot help but get rich over a lifetime. A question about, hey, how's Rick doing? Got converted into a lesson on leverage and compounding and modest lifestyle and so on. And then, of course, I didn't expect him to introduced us to Charlie. And I didn't expect the Charlie meeting to go anything beyond one lunch. So they've been, it's the gift that keeps on giving. So it's been, one of those most no brainer things that I could have done. I didn't do it from the perspective of getting anything out of it, but it turned out to be like an amazing set of things that happened.
Mr. Munger certainly will. I think the most incredible book I've read on investing was just Poor Charlie's Almanac. I mean, half of it is life advice and half of it is investing. And that brings me to the next question, which would be, what resources have you found as an investor to be the most helpful in your education as an investor, maybe when you were still learning about the art of investing?
Yeah, I mean, I think Poor Charlie's Almanac is a wonderful book. And I try to read every year because every year I read stuff that I can swear I never read before. So even though I've gone through the book several times, so it's like a Bible, got a lot of take home value, and especially the talks at the back, and especially like the psychology of human misjudgment talk. There was a book written by Thomas Phelps 50 years ago called 100 to 1 in the stock market. It's an exceptionally well written book. It's not that popular, but I think that book can be really helpful in setting your frameworks. And he was a journalist, and I think he did a great job writing that book. I think that book can be useful. The Berkshire letters obviously are great, going through those. And then they've posted all the Berkshire annual meetings on buffett.cnbc.com going back to the 90s. I listened to all of those in the shower for about 6 months twice, into the whole thing twice. And I've been to every meeting since 98. So going for a while, I think 2024 was 25 years. So it's been a while. Yeah. So I think these are some good resources, and these will probably get you other jumping off points as well.
People are very interested in Dakshana Foundation and the work it does. It's a very unique non-profit organization. And first of all, how can people contribute to the foundation? And could you maybe give us a little more detail as to how Dakshana goes about educating young impoverished children and really adding a lot of value to their lives? And
Yeah, well, we welcome any support. Dakshana is a public charity. So it started as a private foundation, and then later we were classified as a public charity. So you can just go to dakshana.org, and we welcome any support. So that's wonderful. I started Dakshana about 15 years ago, and I was in my early 40s at the time. It seemed to me that it was highly likely that because we had a fairly modest lifestyle, and because compounding worked so well, and you're getting, fees on other people's money and so on and so forth, we were going to end up with meaningful sums well beyond what we needed. It's generally a bad idea to have large inheritances. They generally do more harm than good. Oh, it's okay to give some head start to your gene pool, but to put them on an IV drip for the rest of their life was probably counterproductive. So if you're not going to give the money to your gene pool, the other option you have is to give it to society. And when I started to think about, okay, what organization should I be thinking about when I get to the point and I want to give away all the money, I really drew a blank. And the reason I drew blank is that most charities are run and set up by people who have great hearts, but not so great heads. And to actually run a nonprofit well, you have to need a combination of a balance between a great heart and a great head. And I found that sorely missing. I thought that people who run charities need to have good capital allocation skills. Those are usually quite rare amongst typical people who are drawn towards running or managing charities. So we end up with a result where there's a lot of well meaning people in charitable institutions trying to do well meaning work. But because they are not capitalized, it's very suboptimal. If I were to ask most of them, okay, so you spent 50 million last year on various programs. What was the impact? And they're not able to quantify the impact in a format that would make sense in terms of, well, how do we increase the impact? So we had X impact with 50 last year. Can we get 30% more than X next year, or 10%, 5% more? They just have no calibration or ability to do that. Or they just do what feels good. And what feels good, or what leads to great pictures in annual reports and so on, is not going to be typically, it's just like great investments. Great investments are not the ones that are touted all the time on CNBC or something. I had a notion that some idiot like me who didn't know anything about charities might be able to do better than these guys, because at least I have a framework in mind of what I'm looking for. So one of the issues with charities is that it's really important to measure outcomes. And most charitable endeavors don't lend themselves to easy outcome measurement. So, for example, if you had a program which gave free needles to the homeless, that's a very worthwhile thing to do. How would you compare that to a program that tries to get homeless people into temporary housing, and then maybe try to get them some mental health resources and other things and get them off the street? Okay. The free needles cost very low amounts per person, and they have some impact for doing that. The second program has a very large cost per homeless person. We don't know which is better. I still don't know which is better, because these are hard to measure. So one of the hacks I did with Dakshana is, we're not going to do things that are hard to measure or impossible to measure. We're only going to do things that are easy to measure. Just like the hack of intrinsic value. We can't figure out intrinsic value in most cases, so we'll just hack it. We'll only go to the ones that we can figure out and then just stick with that universe. And so that was the first hack, which is focus on things that are easy to measure. And then once we in our case, it was education. And once we got to a program which I thought had really high returns on invested capital and was easy to measure, we identify very poor kids who are very gifted, 16 to 18-year-olds. And then we prep them for getting into the top end colleges in India, the IITs or medical school and so on. And in India, these universities are very cheap to attend. So once you get in, affordability is usually not an issue. Loans, etc., available. But getting in is difficult because the entrance exams are hard. Can't really get in unless you're coached, and the coaching is very expensive. So we basically level the playing field and made the coaching free. And we can measure outcomes because every year we get a report card from an independent entity which tells us how many of our kids got accepted at IIT and how many got accepted at school, etc. So we can't. My team cannot fudge the numbers. It's not an internal test. It's a very black and white external benchmark. And so we have metrics that allow us to measure. We have metrics that tell us how much it costs us per kid. We can see how many kids and families facing poverty, and we can even try to extrapolate lifetime benefits and such they are getting. So it's a very measurable. And I think that's Dakshana appeals to a lot of people because it's very holistic in its approach.
I would like to conclude the interview with, obviously it's an absolute honor to have you on the show, and thank you for taking the time even after the health incident. So investors who are interested in Pabrai investment funds, how can they reach out, and maybe social or website links can we provide that allow them to do so?
Well, I mean, I think you can just Google me and the Pabrai funds. Google will direct you to me. I have a blog, chaivithpabrai.com, and that's another place you can. It's got a bunch of free resources for investors. Yeah, so I think Google can answer all your questions.
With that, I would like to end the interview, and thank you for taking the time. It was an absolute honor to have you on the show.
Thank you, Siddharth. Actually, I enjoyed the questions. I appreciate the work you did and such in preparing, but it was fun. Thank you.
Thank you. Thank you for coming.
All right.